Hello everyone, let us continue with our discussion. So in the previous lecture, I have introduced you that we are starting with our fixed income forecasting. Clear? Now when I am saying fixed income forecasting, what I have to forecast? The interest rate. Interest rate is actually composed of four different factors: your risk-free rate, your term premium, your credit, as well as your liquidity. The first component we have already studied. Clear? Coming to the second component, that is your term premium. So this is basically the extra return which investors demand for investing in the long-term bonds instead on the short-term bonds. Because try to understand that this is my company and I am taking the money from you. If I am taking it for 3 months versus I am taking it for 30 years, they both are very different, because we know that in 3 months nothing big can happen, though it can happen, but the probability is very less. But in the period of 30 years anything can go wrong, because it's way too huge. Even there is a possibility that my country can also come under the debt crisis. That is also the possibility. Clear? So I am an investor, I am demanding for the extra return because I'm investing in the long term bonds rather than the short term bonds. Clear? Now, what are the possible risks? It starts with the inflation uncertainty. Okay, inflation might goes up, interest rate may change. Clear? Economy may shift. Clear? Earlier your economy was in a boom, but now it is in a recession. Clear? So if I lock my money for 10 years, 20 years, 30 years down the line, I want extra return, and this extra return is known as the term premium. Are you clear with this? Now, sometimes some analysts say that we can just check the yield curve. Trust me, they cannot give the true term premium alone. Okay, you will not get the holistic picture from the yield curve itself. Okay, because we can look at the spot yield curve, basically the graph of the interest rate across different maturity, but the real term premium cannot be found exactly from the yield curve. Okay, why? Because the yield curve combines two aspects. One is expected future short-term rates. Expected future short-term rates. Short-term rates. Clear? And another one is term premium. So we need some other factors as well to understand this component of the term premium. Clear? Now term premium is usually positive. You will never see that term premium, you'll find it negative. No. So empirical evidence have suggested that term premium is always positive, because longer the time, the more the risk. Clear? So it always increases with the duration. So if the bond is of longer maturity, then the term premium is going to be higher. Clear? So there are four different drivers of the term premium. What are those four different drivers? We starts with the inflation. Inflation is something which is uncertain. Okay, not knowing that how much price will increase in the future. So if inflation will become unpredictable, then investor will fear that my long term money may lose the purchasing power. So they demand higher term premium. So inflation is high, uncertainty is high, the term premium is also going to be high. Like if in India, okay, the inflation will jump from 5% to 9% suddenly, then investor will demand more return on the long term bonds. Now let us understand the second primary driver, that is your recession hedge effect. See, this is slightly tricky, so what I'll do, I'll try to make it easier for you to understand this. So over here, what I'm going to understand is two aspects. One is the bond return, something which we are already discussing, bond returns. And second is your economic growth. Economic growth. Now, they both can be positively correlated, they both can be negatively correlated. Positively correlated means they both are going up together, or this one is going up and this one is going down, or vice versa. Means they both can move in the opposite direction, they can move in the same direction. Clear? So now let us understand the first case when inflation comes from the strong demand. Inflation comes from strong demand, means your economy is good, growth is high, inflation is rising. Why? Because people are buying more and more. So what will happen in this case? Bond returns will fall when growth will rise. Why? Because bonds returns bond returns bond return will fall when the growth will increase. Clear? They are moving in the opposite direction, negative correlation. Clear? Bond will protect you during the recession because the bond is giving you regular returns. Clear? Where stock markets or other assets have reduced the value of the asset, but still bond is giving you the return. So investors are happy to hold the long-term bond, and in that situation your term premium will become low. So think like that, your bonds are acting as an umbrella. When the economy rains, investor needs less extra return, because see, they now try to understand, you have three options. Okay, during the bad situation, equity is giving you the negative 18% return, real estates giving you the negative 24% return, but bond is giving you the return of say positive but 4% only during the bad time. So now are you happy with 4 or not? The answer is yes. So even in the worst case scenario, if I'm going to get the lesser money, I'm still happy even for the long term period. Are you clear? Because at least I'm getting something which is difficult with the other asset class. Clear? Hopefully you understand the first case. When inflation will come from the strong demand, your bond return will fall. You see, earlier it was 6%. Now it is only 4%. But still you are happy with it. You are still happy with, because other asset class is not giving you the required return. Clear? So the first case is clear, when inflation comes from the strong demand. Now when the inflation come from the supply shock, when inflation will come from the supply shock, give the heading when inflation comes from supply shock. What will happen in that situation? See, oil price will rise, oil price will increase. Clear? Supply chain will breaks because everything is become very costly. Clear? You will see the shortage of the food is also increasing. This leads to the inflation. This leads to the inflation even while the economy is weak. So during this situation, inflation is rising when the economy is weak. In the previous situation, inflation is rising but the economy was good. So this is the worst scenario. Over here the bond returns will rise with the growth. Why? Because now I feel it's very risky, I need more return. So bond will not protect you in the recession. Now in that situation, investors demands for extra compensation, and hence the term premium will become high. So if I'm going to invest in the bonds with longer term maturity, I will demand for the higher returns. Are you clear? So point 2, recession hedge. Clear? So demand driven inflation, that is our first case, nominal bond hedge, and the long term, the term premium is going to be low. When the inflation is because of the supply side, the term premium is going to be higher. Clear? Coming to the third aspect. Third aspect is your supply and demand of the government bonds. Clear? See, if government will issue the more long-term bonds or few long-term bonds, then what will happen? Clear? There are two situations. You will get more long-term bonds or less long-term bonds. Now, if there is more long-term bonds, supply will increase, yields will also increase, term premium will also rise. Huge supply, interest rate is huge. Why? Because the government want to sell. So investor will purchase more and more. In which situation? When the interest rate will increase, when they are giving us that uh, motive to purchase higher yield, term premium will increase. Clear? Fewer bonds, limited supply, yield will fall. Everyone wants. So if you are looking for the same bond and I am also looking for the same bond, you say 6%, I'll come and go to the government. See, I'm ready at 5.5. The yield will fall, term premium will also fall. Clear? So in this situation, when the demand is high, yield will increase. When demand is less, when supply is less, yield will decrease. Clear? Higher supply, higher yield, lower supply, lower yield. Are you clear? So supply and demand situation. Coming to the fourth one, that is your business cycle. Phases of economy: boom, recession and recovery. So during the boom, economic activities are strong, inflation risk is high and term premium is also high. During recession, economic activities are weak. Investors buy the long-term bond for the safety and hence the term premium is low, because over there I am also willing to take the bonds even I'm getting 3%, because at least I'm getting 3% from the bonds, but from the real estate and the economy I'm not getting it. So always remember, during the recession the return on the bonds is less but higher as compared to other assets. During the boom, I'll go to the real estate, I'll go to the equity, I won't come to the bonds. So in that situation, government will come and push, see, purchase my bonds, we are giving you higher return. That's why during the boom, the term premium is going to be higher. Are you clear? Now, just like we have seen some primary drivers, there are some indicators as well that will influence the term premium forecast, or basically the indicators. Clear? Like ex ante real yield. Ex ante means expected future, real yield means yield after removing the inflation. So higher expected real yield means higher term premium. So if this is high, that means term premium is also high. Clear? Then Cochrane and Piaget's curve factor. Okay, don't get confused with these words. They simply measure the slope and the curvature. Slope means the steepness of the yield curve, and curvature, that how it is actually bending. So it actually helps to predict the future bond return and the term premium. You don't need to memorize any of these formulas, just the meaning, that what I am calculating, what I am trying to understand is the slope and the curvature of the curve. Clear? So it actually helps to predict the future bond returns and the term premium. Third is your Kim-Fried term premium model. So this is a three-factor model that breaks the interest rate into three components. One, expected future short-term rates. Second is your term premium, and third is your other macro factors. And this is used by the Federal Reserves, and with that they calculate the interest rate. Clear? Slope of the yield curve. Now, if it is steep, that means high term premium. If it is flat, low term premium. And if it is inverted like this, that means negative term premium is possible, but we haven't seen it. Clear? Then we have the fifth one is the supply indicator. Okay, portion of the government debt with the maturity. If it is greater than 10 years, then more long-term supply leads to the higher term premium. We have discussed it over here. Okay, supply and demand. So, but their focus is on greater than 10 years. The bond with the maturity of greater than 10 years. If the proportion is high, then the term premium is going to be higher. Clear? Similarly, the next one is your cyclical indicators, like your profits per GDP, your level of confidence, your unemployment rate. Like if unemployment rate is high, recession risk is high, hence the term premium is low. High profits, strong economy, that means higher term premium. So all these are interconnected to your primary driver, because profits, strong economy and recession, we have already discussed it. Clear? Now coming to the next point to be discussed, that is your credit premium, that is the compensation for the default risk. See, this is something we have discussed a lot in your level 1 as well as your level 2. So if I know that you are risky, then what I'll do, I'll demand for higher returns. Clear? So higher the risk, higher the returns. Clear? Now it is a part of the credit spread. You remember credit default swap, credit swap. So if the expected default losses is high, then my CDS, credit default swap premium, is also be higher. Clear? So credit premium is compensation for the default risk. What is expected default loss? Amount you expect to lose in case if there is a default. Clear? Now what you can do is just pause the video and go through it. The points which I mentioned here, they all are done before in your level 1 and level 2, nothing new. Now over here you can see the first point, that is your yield spread is not a good predictor of the default rate. So why? See, there are 2 points. First of all, yield spread include only a small return premium. Small return premium. And second point, yield spread is not a good predictor of the future default rate, because just because the spread is high, it will not guarantee that there is a default. You are charging the high return, so it's not a guarantee that the default will happen. There is a probability. Clear? So the spread, when I'm talking about the spread between the government yield and the corporate bond. Clear? There is a difference, and that particular difference is going to have a premium. Now this premium is small. Sometimes this premium is uneven. Sometimes it's very high, sometimes it's very low. Sometimes you will see that I have told you cluster means during the recession you will see many defaults are coming together. Clear? Otherwise the same company is not defaulting in a boom period, but the similar companies and even the good companies, they are getting defaulted during the recession. Clear? That's why this yield spread is not a good predictor of the future default rates. Clear? So my spread is actually influenced by stock returns, stock volatility, as well as the risk-free rate. Clear? So they will actually tell me more about the predictive power. What is the probability of the default? Like when I'm saying stock returns, so how much the stocks are going up and down. If it is going way too low, then the chances that the company can default. If the volatility is very high, then also there is a chance of the default. Risk-free rate increased, chances of the default. Clear? Weak drivers, they will have a low predictive power, like GDP growth, default rate changes. First of all, they take huge amount of time to actually reflect and to tell us that there is a possibility of higher default. Clear? And sometimes GDP won't tell you about the specific companies who can default in the given time period. Clear? One way to understand the default rates is through the rating of the bonds. AAA, AA, they have a very low default rates, and their credit premium is mostly due to the downgrade bias. Now what is this downgrade bias? Downgrade bias means it is easier for a company to get downgraded than upgraded. Clear? It is easier for a company to get downgraded than upgrade. To upgrade themselves from AA to AAA, they have to prove a lot, but to become AAA to AA, it's quite easy. You just do something and you will see that your credit rating immediately will see the impact. Clear? And this asymmetry will cause some extra spread. So the credit premium is not for the default risk, but for the rating downgrade. Clear? Means if the rating downgraded for say some reason, so this does not mean that something worst has happened to the company. No, but because I have downgraded the company and hence I am putting the credit premium on you. Clear? So there are some low grade bonds as well. For them the spread is high and they will reflect your actual credit risk. For higher bonds, it's very difficult to reflect the actual credit risk, but for the low grade bonds, yes, there are chances that they will default, and hence the credit premium is also going to be higher. Now over here, if I'll share some critical information with you, some historical evidence about the US corporate bonds. One is high option adjusted spread leads to the higher credit premium. Write it down. High option adjusted spread leads to the higher credit premium. Why? Because what is this OAS? OAS is a measure of spread after removing the embedded option effect. Clear? So if it's high, then credit premium is also going to be high, because there is a possibility that either company can call the bonds or the bond holder can release the bonds. Clear? That's why the credit premium is also high. Second is steep treasury yield curves like this. This leads to the declining default rates. So a steep curve means what? Short term rates are low and the long term rates are high. Clear? So steep curve is basically during the good times, and hence the default rates are expected to be very low. Clear? So again, I am repeating, if my steep curve, my yield curve is steep, that means the credit premium is also high, along with the term premium is also high. Clear? So both are bullish, means there is a positive outlook, because investors will get higher compensation for the higher risk. Clear? See, there is one more point, must write it down. Credit premium is not higher for longer maturity. For longer maturity, you are getting the term premium, but not the credit premium. Credit premium is highest for the short term maturities. Why? Because of there are two reasons. What are those two reasons that the credit premium is high for the short term maturity? One is your event risk. Means a default is a big negative event, but a bond can never pay more than the face value. So upside is limited, but downside is huge. So short term default risk gets priced more. Basically in short term, there is a higher default risk. Illiquidity, old short term bonds which are close to maturity, they are not getting traded much, and hence less liquidity, higher credit premium. So they are the two reasons that why my short term maturity bonds will have higher risk. Clear? Credit risk more specifically. Clear? Then we have is the barbell strategy. What is this barbell strategy? Barbell strategy means take the credit risk in short term bonds and take the duration risk in the long term bonds. Write down. Take credit risk in short term bonds, take duration risk in the long term bonds. So basically it is going to give you the higher credit premium for short term bonds, higher term premium for the long term bonds. Clear? So best for both scenarios. Now finally coming to the liquidity premium. Okay, liquidity premium means higher the liquidity means easy to buy and sell, low liquidity means hard to buy and sell. So liquidity premium is basically the extra return which investors require for holding that bond that is not very liquid. So for them it's very hard to sell. Then what they will do? They will put some extra liquidity premium. Clear? So in the very first few weeks after the bond is issued, the liquidity premium is the highest, because the new bonds are generally actively traded. Everyone wants them, price is clear. But once after a point of time, no one is trading into those bonds, no one is talking about it, price is not clear, less liquidity, and hence the liquidity premium is now getting charged in your bonds. So liquidity premium is higher for the new issues, high credit quality bonds, large issue size, frequent issuers, simple structures, and the bonds which are near to par value. Okay, so before the end of this lecture, I'll say that I have completed all the 4 points where you will use to identify the return of the bonds, your risk-free portion, credit, liquidity, and your term premium. Clear? With this, I'm ending this lecture here. Thank you.